If we just briefly stay on this chart where it shows modified adjusted gross income, what is the difference between that and adjusted gross income, and why is that important, especially as somebody's nearing retirement? Modified adjusted gross income, use the example of tax-free muni bonds. Municipal bonds are federally tax-free. So an effective strategy is for retirees to collect interest from those tax-free muni bonds and say, okay, I'm going to live off the interest. That's going to be a portion of my income, and that's excellent. So from an adjusted gross income standpoint, it's not included in the AGI, but from a modified adjusted gross income, it is. Why is that important for retirees? Well, majority of individuals are going to be leveraging something known as Social Security income. When somebody uses Social Security income, the way on how the government looks at how your Social Security is taxed, or what is your benefit that is eligible for taxation, they're going to look at your modified adjusted gross income. They're not going to look at your adjusted gross income. The same with IRMA tax, which is a really, think of it like a penalty or an extra premium when somebody is eligible for, or they have Medicare Part B and Part D premiums. If their income is too high, if their modified adjusted gross income is too high, it's going to now make them pay a higher premium in addition per month for that Medicare Part B and Part D. So those are really two main areas, two main negatives when we were looking at the difference between modified adjusted gross income versus adjusted gross income, when somebody's thinking that they're leveraging a tax-free benefit. And really, the modified adjusted gross income is still calculating that tax-free benefit, such as the municipal bond interest. What does MAGI, or modified adjusted gross income, what does that look like when you're leveraging Roth IRA accounts? When you're taking out qualified distributions from a Roth IRA account, this means, let's say you converted dollars, the monies are growing tax-free, you're pulling those dollars out tax-free. How does that affect the modified adjusted gross income? And it doesn't. So you could be, if you play your cards the correct way and you're taking out withdrawals from Roth IRA accounts in the future, you could have a very small modified adjusted gross income. So when you're looking at how much of your Social Security benefit is taxable, you could be sitting at 0% of that benefit could be taxable. So the way on how Social Security taxation works is your benefit could either be taxed at 0%, 50%, or 85% based on what your provisional income calculation. I have a very detailed video on that, so I definitely recommend to watch that. But just be mindful that you don't want to hoard too many dollars in the wrong area. Another example would be NIIT, is a net investment income tax, where you could be charged an additional 3.8% of net investment income could be taxed at an additional 3.8% if you're over specific thresholds. So when you're looking at these conversions and you're doing it incrementally, it's not just about increasing or trying to fill up your buckets, but you also want to make sure you're still having access to the proper credits and you're not shooting yourself in the foot. And you want to look at it on a case-by-case basis, a year-by-year basis, and make sure that there's some sort of strategy in mind. Individuals could do it themselves, which is fine, or they could ask for help, and that's where we have an entire division that helps out individuals that call over to our agency. What do I mean by that?